December 24th, 2025. Christmas Eve. Most of the Western financial world is closed. London's gone dark. New York's skeleton crew. The Asian session is running on fumes. Barely anyone at their desks. And then gold does something that shouldn't be possible. It crosses $4,500 an ounce for the first time in history. No news catalyst. No Fed announcement. No geopolitical crisis. Just a $50 intraday range that rips through the market like a knife through wet paper. Because here's what actually happened: the people who normally absorb price movement, the market makers who provide liquidity, they stepped away for the holiday. And what was left, the thin order books and skeleton crews, couldn't handle the pressure. Gold didn't move because of news. It moved because the infrastructure that makes markets function disappeared, and the marginal flow that remained had nowhere to go but straight up. That's not a prediction about where gold's headed next. That's a lesson in how fundamentally the structure of this market has changed, and almost nobody noticed until it was too late. My name is Alex, and I've spent the better part of 3 years reverse engineering why gold stopped behaving like a normal commodity and started acting like something else entirely. If you want to understand what's really happening in precious metals markets while everyone else is still reading charts from 2010, make sure you hit that subscribe button and give this video a thumbs up if it gives you clarity on what the data is actually telling us. Here's what I'm going to show you. Gold gained over 70% in 2025. Best annual performance since the late 1970s. It set more than 50 all-time highs. And yet, if you look at Western gold ETF holdings, they stayed flat through most of the rally. The move didn't come from retail speculation. It didn't come from hedge funds piling in. The entire structure of who's buying gold and why they're buying it has shifted underneath us, and the pricing models everyone's using are based on a market that doesn't exist anymore. Now, conventional wisdom says gold moves on two things: real interest rates and fear. When rates go up, gold goes down. When people panic, gold goes up. That's the framework. That's what every analyst on television will tell you. But here's what they're not telling you. That framework assumes the marginal buyer is making a financial calculation. It assumes they're comparing gold to bonds, running yield analysis, and making rational allocation decisions. And for decades, that was true. The marginal buyer was a Western institutional investor or a retail trader watching CNBC, but not anymore. Central banks bought over 1,000 tons of gold in 2022, over 1,000 tons again in 2023, over 1,000 tons again in 2024. 3 consecutive years. Total across those 3 years, 3,220 tons. That's double the amount they bought in the prior comparable period. And here's the part that changes everything. Central banks now account for over 20% of total gold demand versus around 10% historically. They've become the marginal buyer. And central banks don't sell into rallies. They don't take profit. They don't run stop losses. They accumulate structurally, regardless of price, because they're not making a trade. They're managing existential risk. Let me paint you a picture of why that matters. February 22nd, 2022. Russia invades Ukraine. Within days, the United States and European Union freeze $300 billion in Russian central bank reserves. $300 billion. Not oligarch yachts, not individual accounts. State reserves. The money a country holds to defend its currency, to manage crises, to maintain financial sovereignty. Gone. Just frozen. And every central bank in the world watched that happen and asked themselves the same question: if we end up on the wrong side of a geopolitical dispute, could our reserves disappear too? The European Central Bank published research in June 2025 tracking this psychology shift. 29% of central banks surveyed said they plan to increase gold holdings over the next 12 months. That's the highest percentage since they started asking the question in 2018. 44% now actively manage their gold reserves for risk management purposes, not just as a legacy asset sitting in a vault. And here's the line that should make your hair stand up: 1 in 4 central banks cited sanctions risk as a primary driver of their gold allocation decisions. 1 in 4. They're not buying gold because they think it's going up. They're buying gold because they watched what happened to Russia and realized that dollars, euros, and yen can be turned off like a light switch. Gold can't. What I'm about to show you next is the thing that took me months of digging through regulatory filings to understand, and it explains why that Christmas Eve price spike wasn't a fluke. Basel Three, the net stable funding ratio. Sounds boring. It's not. Here's what it does. It requires banks to hold stable funding against their assets based on how liquid those assets are. Cash, No problem. Government bonds? Pretty good. Stocks? You need more stable funding. And unallocated gold, the kind that bullion banks use to make markets and provide liquidity, gets treated at an 85% required stable funding ratio. The same treatment as corn, as wheat, as industrial commodities. Gold, which trades $104 billion a day on COMEX alone as of Q3 2025, gets treated like it's an agricultural product. That regulatory treatment makes market making in gold expensive. It ties up capital. And when you make something expensive for banks to facilitate, they do less of it. Order books get thinner. The number of participants willing to step in and absorb flow shrinks. And here's the kicker. The market looks liquid right up until the moment it's not. You see 104 billion in daily volume and think, this market's deep, I can get in and out whenever I want. But that liquidity is provided by a shrinking number of market makers who are increasingly expensive to operate under post-Basel Three rules. So when they step away, when it's a holiday or a weekend, or just a moment when liquidity providers decide the risk isn't worth it, price doesn't trend, it gaps. December 29th, 5 days after that Christmas Eve spike, COMEX raised margin requirements on gold futures. Standard risk management, right? Except here's what happened. Gold dropped 4.5% intraday. 4.5%. In a matter of hours. Because the market was levered up, and when margin requirements increase, leveraged positions have to unwind, and they unwound into thin books. Into a market where the people who normally catch falling knives weren't there or weren't willing to step in at prevailing prices. The move down was just as violent as the move up. Same root cause. Structural fragility masked by surface liquidity. If you've made it this far, you're already ahead of 90% of people who think they understand gold. But don't stop now, because what comes next is where the conventional analysis completely falls apart. Let's talk about why traditional gold analysis stopped working. Every model, every forecast, every price target you see published assumes that the marginal buyer is doing a calculation. They're comparing gold's non-yielding nature to bond yields. They're weighing inflation expectations. They're running some version of a real rate model. And if you're a hedge fund or a retail investor, that's exactly what you're doing. But central banks aren't running those calculations. Or rather, they're running a completely different calculation. China's central bank, the People's Bank of China, added to its gold reserves for 18 consecutive months from November 2022 through May 2024. 18 months. Then they paused. Did gold become less attractive? Did real rates change their calculus? No. They hit an internal allocation target and shifted focus. But while they paused, other central banks kept buying. India, Poland, Singapore, the Czech Republic, Turkey. The composition of buyers shifted, but the aggregate flow stayed positive. 20+% of global demand coming from buyers who aren't price sensitive in any traditional sense. And here's the thing that breaks every model. Central banks don't just buy differently, they hold differently. The World Gold Council's Q3 2025 report showed that official sector holdings, that central banks, now sit at over 36,000 tons. They don't churn, they don't trade around positions, they accumulate and sit. Which means every ton that moves from the private market to the official sector is effectively removed from the tradable supply. It's not coming back. Not in a rally, not in a correction. It's locked away as settlement insurance. Let me explain what I mean by settlement insurance, because this is the core of why gold's behaving differently. Traditional finance runs on counterparty risk. When you hold dollars, you're holding a liability of the Federal Reserve. When you hold treasury bonds, you're holding a liability of the United States government. When you hold euros, you're holding a liability of the European Central Bank. Every financial asset is someone else's promise, and promises can be broken. They can be frozen. They can be printed into worthlessness. They can default. Gold is no one's liability. It doesn't require someone else to make good on a promise. It just sits there, physical, inert, can't be printed, can't be frozen, can't default. When central banks buy gold, they're not making an investment. They're reducing counterparty exposure. Now stay with me here, because this next part is where it all clicks. The 70+% gain in 2025 wasn't a speculative bubble. It wasn't retail investors piling in. Western gold ETFs, which are the easiest way to track retail and institutional sentiment, showed flat to declining holdings through much of the year. GLD, the largest gold ETF, actually saw outflows in several months when gold was making new highs. That's not how bubbles work. In a bubble, retail chases price. The Robinhood crowd piles in. ETF assets under management explode. That didn't happen. Instead, you had structural buying from central banks absorbing supply, and a regulatory environment making it expensive for banks to provide liquidity, and eventually price had nowhere to go but up. Not because people were excited, because the market structure couldn't absorb the flow. Vanek published analysis in 2025 pointing out that gold's correlation to real yields, which had been the dominant driver for decades, started breaking down in 2022 and fully decoupled by 2024. The model that worked for 40 years just stopped working. Not because the model was wrong in theory, but because the marginal buyer changed. If you're still using a real rates framework to forecast gold, you're flying blind. You're using a map from a different territory. JP Morgan's Global Commodities Strategy Desk noted in December 2025 that gold's behavior increasingly resembles currency dynamics rather than commodity dynamics. It's not trading on supply and demand fundamentals, it's not trading on jewelry demand from India or industrial use cases. It's trading on monetary trust, on reserve diversification, on geopolitical fragmentation. Those aren't factors you can plug into a spreadsheet and get a clean price target. They're regime level shifts. Now let me tie all of this together, because when you see how these pieces connect, the Christmas Eve price spike stops looking like an anomaly and starts looking inevitable. You have central banks structurally buying 20+% of annual supply. You have Basel Three regulations making it expensive for banks to facilitate gold transactions. You have ETF flows showing that Western speculators aren't the marginal buyer anymore. You have a market that looks liquid on the surface, 104 billion a day in COMEX volume, but that liquidity is provided by fewer participants holding less inventory under tighter regulatory constraints. And then you have a holiday. Christmas Eve. Thin Asian session. Skeleton cruise. And someone, maybe a central bank, maybe a sovereign wealth fund, decides to put in a large order. Not market moving size in a normal environment, but in a thin market with no one on the other side, it doesn't take much. $50 million of flow that would barely move the needle on a normal trading day instead pushes price up $50 because there's no one there to absorb it. And here's where it gets really interesting. That move up triggers stops. It triggers algorithmic trading systems. It triggers momentum traders who see a breakout and pile in. And now you've got a feedback loop. Price moves because liquidity is thin. That move triggers more buying. That buying hits even thinner liquidity. And suddenly, gold is at 4,500, everyone's scrambling to explain what news event caused it. There was no news event. The market structure itself was the event. 5 days later, December 29th, COMEX hikes margins. That's their job. Volatility goes up, margin requirements go up. Standard stuff. But all those momentum traders who piled in, all those algorithmic systems, they're running on leverage. When margin requirements increase, positions get cut. Forced selling. And just like the move up, the move down hits thin liquidity and gaps. 4.5% intraday. Not because the fundamental case for gold changed, because the structure of the market amplifies moves in both directions when liquidity disappears. This is the part where most people check out because it's uncomfortable, the realization that markets aren't efficient. That price doesn't always reflect information. That sometimes, maybe more often than we want to admit, price just reflects who's on the other side of the trade and how much capital they're willing to deploy at that moment. Gold at 4,500 on Christmas Eve wasn't telling you that gold was worth 4,500. It was telling you that at that moment, in that market, with those participants, that's where the marginal transaction cleared. 2 days earlier, with normal liquidity, maybe it would have been 4,420. 2 days later, after margins hiked, it was back down to 4,300. The price isn't the information. The structure is the information. Now we get to the part where I have to address what you're probably thinking. Does this mean gold's going higher? Does this mean you should buy? And here's my answer. I have no idea where gold's going next. Neither does anyone else, no matter how confident they sound. What I do know is this. The framework that worked for analyzing gold for the past 50 years doesn't work anymore. If you're still looking at real yields and inflation expectations and trying to model gold like it's 2010, you're going to keep getting surprised. The marginal buyer changed. The liquidity structure changed, the regulatory environment changed, and price behavior changed as a result. Central banks are going to keep buying, not every month, not in a straight line, but structurally they're allocating more to gold than they have in generations. That's not a prediction, that's observable behavior that's been consistent for 3 consecutive years. Basel Three isn't going away. If anything, regulatory scrutiny on bank balance sheets is increasing, which means market making in gold stays expensive and liquidity stays structurally thinner than it looks. And geopolitical fragmentation, the thing that's driving central banks to diversify away from dollar reserves, that's not resolving anytime soon. What that means for price, I genuinely don't know. You could make a case that structural buying plus thin liquidity equals sustained upward pressure. You could also make a case that leverage unwinds and thin liquidity cuts both ways, and the next margin hike triggers a violent correction. Both of those things can be true at different times. What I'm telling you is that the old playbook doesn't apply. The market's not behaving like it used to because it's not structured like it used to be. Visual Capitalist published a breakdown in October 2025 showing the shift in central bank gold purchases by region. It's not just China, it's not just one or two countries. It's broad-based accumulation across emerging markets, across Eastern Europe, across Asia. Diversified buying from buyers who are making decade-long allocation decisions, not quarterly trades. That kind of flow doesn't reverse on a Fed announcement. It doesn't reverse on a yield curve move. It's structural. And the Western financial system, the banks that provide liquidity, the ETFs that allow retail access, they're built for a different kind of market. They're built for investors who buy on dips and sell on rallies, who respond to data, who trade around positions. Central banks don't do any of that. They accumulate into strength. They hold through volatility. They don't care if gold goes from 4,500 to 4,300 because they're not managing a portfolio to benchmark. They're managing reserves to survive a monetary crisis. The Incrementum Research Group, which publishes some of the deepest analysis on gold market structure, pointed out in their June 2025 Basel Three regulatory analysis that the full impact of the NSFR rules hasn't even hit yet. Some provisions are still phasing in. Some banks are still adjusting their business models, which means the liquidity environment that felt thin in 2025 could get thinner in 2026 and 27. Not because people stop caring about gold, but because the cost of facilitating gold transactions keeps rising for the institutions that make markets. The thing nobody's talking about, the thing that makes this whole situation so fragile, is that it's invisible until it's not. On a normal trading day, you don't notice that liquidity is thin. You put in an order, it fills, life goes on. But when everyone tries to move at the same time, when a holiday thins out the participants, or a volatility spike triggers risk controls, suddenly you're in a different market. You're in a market where small flows move price violently because there's no one there to absorb them. And you can't predict when those moments happen. You can only understand that the structure makes them inevitable. Let me show you what I mean with one more data point. EBC Financial Group published analysis in December 2025 looking at bid-ask spreads in gold futures during different trading sessions. Normal US trading hours, spreads tight. Good liquidity. Asian session during US holidays, spreads blown out. 5, 10 times wider than normal. That's the tell. The market looks liquid when everyone's there. It's not actually liquid when it matters, when you need to move size and no one's on the other side. Christmas Eve wasn't an aberration. It was the structure revealing itself. So here's what actually matters. If you're invested in gold or thinking about it, stop looking at it like it's 2015. Stop waiting for a correction based on yield analysis. Stop assuming that because ETF flows are flat, the rally's fake. The rally's not fake, it's just not coming from where you think. It's coming from structural, non-price sensitive buyers accumulating into supply that's increasingly expensive to provide. That doesn't mean gold only goes up. It means the moves are going to be violent in both directions, driven more by liquidity and positioning than by information. If you're trading gold, understand that leverage is playing with fire in a market this structurally fragile. That Christmas Eve spike and the December 29th dump are what happens when leverage meets thin liquidity. You can be right about direction and still get wiped out by volatility. If you're holding physical gold as part of a long-term reserve strategy, this analysis should make you more confident, not less. The central banks are doing the same thing you are, just with bigger numbers. If you're ignoring gold entirely because you think it's a barbarous relic, you're missing the point. The world's central banks clearly don't think it's a relic. They're accumulating it faster than they have in 50 years. The 70% move in 2025 wasn't a prediction anyone could have made with precision. But it wasn't random either. It was arithmetic. When structural buyers dominate marginal flow and liquidity providers step back, price gaps rather than trends. When the marginal buyer doesn't care about price, traditional valuation models break. When regulatory rules make market making expensive, liquidity dries up exactly when you need it most. None of that tells you where gold's headed tomorrow or next month. But all of it tells you that analyzing gold the way we used to is a waste of time. Gold's moving for a reason nobody's talking about. Not because of inflation, not because of fear, not because retail investors are piling in. It's moving because the infrastructure of the market changed, the identity of the marginal buyer changed, and the behavioral patterns that drove price for decades don't apply anymore. That Christmas Eve spike to 4,500 wasn't the start of something, it wasn't the end of something. It was a window into how fragile this market really is beneath the surface. And once you see it, you can't unsee it. You wanted to understand why gold's acting strange. Now you do. The question is what you do with that information, because the market's not going back to how it used to work. The central banks are going to stop buying. Basel Three isn't getting repealed. Liquidity isn't going to magically improve. We're in a different regime now, and the people still using maps from the old regime are going to keep getting lost. What's the next financial structure shift you want me to dig into? Federal Reserve balance sheet mechanics? Treasury market liquidity? The Eurodollar system that's quietly unwinding? Drop it in the comments. That's what this channel exists for, making sense of the market structure changes that everyone else is too busy to notice until they're already getting wrecked by them. Your future financially informed self is going to thank you for paying attention now, because when the next volatility spike hits and everyone's confused, you'll know exactly why it's happening. You'll understand the structure, and understanding the structure is the only edge that actually matters.